All right, welcome everyone to SSP live stream. Today is March 20th, 2023. How are you?
Today is March 20th,
Why am I
2023.
hearing
How
that?
are
Hold on
you?
one second.
Why am I hearing that? Hold on one second.
I'm in stereo. Hang in there with me. Hold on. Got so much to cover
I'm in
today.
stereo. Hang in there with me.
Okay,
Hold on.
I
Got
think
so
I
much to
figured it
cover
out.
today. Okay.
Maybe I
I think
did.
I figured it out.
Oh, why
Maybe
is
I
it
did.
doing that? Hold on one second here.
Oh, why is it doing that? Hold on one second.
Bear with me.
Bear with me.
Okay, there we go. All right. I've been thinking a lot about this whole bank situation here, and it bears another look at the correlation between '07, because that's our most recent bank failures, was back in 2007. And I just want to show you, this is from the FDIC. Bank failures in brief summary 2001 through 2023. Now, 2007 was when there were three bank failures. It's sounding eerily similar to what's going on now, right? Three, the red line shows the number of bank failures, and the green line shows the total assets that those banks had. So '07 was literally the financial collapse in the real estate market, with loans so it was basically a credit collapse. People were receiving loans who didn't really have the means to repay them, and there was a lot of money generated in loans that were ended up being defaulted on, and ultimately homes foreclosed on. Now, this time period was called the Great Recession, but what I want to point out is '07 was the beginning of this, with three bank collapses back in 2007. 2008, there were 8 times the number of collapses. It went from 3 to 25. But look at this, 2009, so 2 years after the credit crisis, 140 banks failed. But then it even goes up from there to 157 back in 2010. So, this is a situation that is going to play out for many years to come. And it's also a situation that is going to bring in an entirely new financial structure. It's here. The Fed even said starting in June they're testing their CBDC, central bank digital currency. The whole idea, in my opinion, the whole idea of all of this failures and collapses and overtaking of certain banks is to usher in this centralized digital currency. Period. Like, that's what all of this is about. It's what it's leading up to. Many countries are already testing this. India, for example, is testing it. 18 different areas of India, including 50,000 people, are part of this test with the central bank digital currency. It's being foisted upon other countries, and there's been pushback. There's been rioting in the streets. And with that, all the banks are doing is eliminating cash. That's the ultimate goal. They don't want you to have cash. They don't want you to transact with cash. It's been leading up to this for a very long time. Again, not fear-mongering, just the reality, sharing the reality of what is involved here and what you can expect. So if we look but here's what I thought was even more interesting about this. When I click on 2007, look at the assets of these banks. Oh, look, it's so low. Here, let me do away with my webcam here. It's so low that it barely registers. See the assets? It's in millions, so this would be 2.5 billion, and then is that 87? So 87 billion in assets. And then we scroll down a little bit, we see these were the three banks that failed in '07. One in early February, 15 million in assets, 12 million in deposits, 2.5 billion in assets is Net Bank out of Georgia, 2.3 billion in deposits. So these numbers are not that large, but let's jump to this year, 2023, and look at this spike here. It's just incredible. 319 billion in assets, 319 billion. Two financial banks, Signature Bank, and then Silicon. That's what I'm calling this one. It's a Silicon. Let me tell you how silly this con is. Prior to the bank being taken over, the CEO, Gregory Becker, sold 11% of his holdings on February 27th, literally 13 days before this bank was taken over. Michael Zucker, the general counsel, on February 5th, so a little over a month beforehand, sold 19% of his holdings. Daniel Beck, the CFO, sold 32% of his holdings on February 27th, the exact same day Gregory Becker sold. And Michelle Draper, the CMO, sold 25% of her holdings on February 1st. I mean, come on. I've always said insiders are not the best buyers of their stock, but they're almost perfect sellers. And they're going to get away with it. They're it just is, right? That's just how the whole financial banking system works. These insiders that know what's going on. And I told you a week before this happened, I got a marketing letter from them trying to get me to transfer our assets over there. But thank God we're fully protected. So none of that happened. And my guides were like, just don't even bother with it. Just ignore it. That's my guidance system that I got around that. It was like, just ignore it. So I didn't spend any energy and time on it. And we don't need to. As a company, we're well collateralized, well capitalized. We're doing well. But I just want to bring to light here, I think we're going to see a whole lot more coming than we even realized. Like, look at the magnitude of only 2 bank failures this year. We had the Silicon, I call it Silicon Bank, was bought out by HSBC, the arm in the UK, for €1. And HSBC has been one of the leaders in cross-border digital currency. So there you go. Signature Bank was bought out by New York Community Bank. At a deep discount. Their bond portfolio was discounted by like 21%. Let me double check my numbers there. 21% here. BlackRock, look at BlackRock, Fund Advisors, one of the largest holders of this bank, largest holder. But look at the other 2 large holders, BlackRock and Vanguard. BlackRock at 10% stake in this bank, Vanguard at 9.52. So between the 2 of those companies, 19.6% ownership of this. So with a large institutional holding, I find it very interesting that 2 individual holders, mutual funds or other, whatever you want to call these institutions, basically are calling the shots when it comes to the transaction of these bank shares, right? They own the majority of it. excuse me, not the majority, but they are the majority institutional holders of that stock, New York Community Bank Corp. So we have that one covered. And then Credit Suisse, purchased by UBS Global. Let's not forget UBS Global is one of those institutions that is, like it says, a global institution that is definitely on board with testing of the central bank digital currencies. And in the meantime, this all happens, at an unprecedented time with finances. I want to share with you the U.S. right now. Let me get back. The U.S. right now has, I have to read this on my phone, a record 16.5 trillion in household debt, a record 11.9 trillion in mortgages. This mortgage environment is way bigger than it was in 2007 because the property values are astronomical. They've risen 40% over the previous 2.5 years. Unbelievable. A record 1.6 trillion in auto loans, a record 986 billion in credit card debt. Total mortgage debt is now more than double in the 2006 peak. Remember, it peaked in 2006 and then it collapsed in 2007. We're double that. Meanwhile, 36% of Americans have more credit card debt than savings, with balances rising at the fastest pace since 1999. So people are paying their bills with credit cards. Balances are huge. Savings is no more. Those are done with. This is while mortgage rates just hit 7.1% and credit card debt rates hit a record of 24.9. Almost 25% is the rate on credit cards. It's just unbelievable what's happened. But this is what I wanted to, let me go back to this chart here. The last part. This is while mortgage rates just hit 7.1%. Now, this is what I want to share with you that I think is super critical to talk about. We had, let's go back to the overall, let me go back to that chart from the very beginning. Here. So, as I mentioned in 2007, 3 banks were the collapse, right? And then 2008, it goes up to 25, 2009 up to 140, and 2010, 157. But you have to remember that during this time, 2008, 2009, 2010, 11, and 12, the Federal Reserve did nothing but get rates to zero. Like they just dropped them. And now, interestingly enough, the Fed is saying, for a nanosecond, they're like, okay, we might be pausing this rate increase, or the market was hoping, the market even priced that into the bonds. The 10-year bond went from the 10-year bond yielded before the collapse of Silicon Bank, the 10-year was, let me go to the home screen here. Bring up our, here we go. The 10-year was at, okay, right now it's at 3.49. So it's dropping slightly. The rate is going up a little bit more, but the rate was nearly 4%. So the market went, oh no, there's this financial panic in here. Most likely the Fed is going to reduce rates, or at least minimize the rate increase, or at least pause the rate increase. And now we're going to find out this Wednesday exactly what's going to happen with this interest rate move. So if the Fed continues to raise rates because, they're bent on a 2% inflation rate in the US, Canada's a little bit better. Kudos to Canada. I'm going to give you full-on credit. The Canada Central Bank did not raise rates last week, which is a huge divergent. Usually they're on par with the US. So I thought that was good. Looking at a more reasonable inflation rate of 3%, not this unreasonable target of 2%. So way to go, Canada. Awesome. Way to be an independent thinker, an independent mover in this political environment. Very proud of you. Proud to be a Canadian. So if the Fed, here's my prediction, if the Fed raises rates on Wednesday, 25, they are going to continue to be the problem here. They're going to continue to be a source of more and more bank failures. Y'all, this just started. This is just getting, it's like the giddy up is getting on. You know what I'm saying? This just started. It will continue. So what can you do as an investor? Well, first of all, do not invest in bank stocks. Stay away. I've been saying for years now, stay away from the bank stocks. There's way too much risk involved. You have no idea what's on their balance sheet. So steer clear. The second thing you do is if you're one of those fortunate individuals that has a large asset base in cash, only if you're in the US, only keep $250,000 per institution, financial institution. And they include the bank CDs in that number too, by the way. It's short-term deposits. That includes treasury bills, bank CDs. In Canada, it includes GICs. So anything that's short-term is part of that number. So FDIC insurance is $250,000 in the US. In Canada, it's $100,000. The Canadian Depository Insurance, CDIC, is $100,000 in each financial institution. This does not include your IRA, your TFSA RSP. That's separate. They insure those up to $100,000 in each financial institution. So Canada's a little trickier because the banks, bought each other out decades ago. So there's only a few big ones left and some community banks. That's what's coming to the US. There's going to be this massive overtaking of the banks by other banks. It's going to be a consolidation like you've never seen before. So do your best to, kind of move the money around in different institutions, know your limits in each institution so that you're covered regardless of what happens. So again, stay away from bank stocks. There's way better investments out there. Finally, like, technology company is saving the day. Now there's a rush to technology, a flight to quality, because of this uncertain time. I mean, it's just such a joke, y'all. This is such a joke. Look at all the Silicon executives who sold their stock before it collapsed. And I want to make one more mention. I feel like part of my role that I play in your life is to help you also learn where to steer clear of certain people out there talking a big story, and that's Jim Cramer. Jim Cramer was the one who said last year, buy Silicon Bank in the $450 range. Quote his words, it's the buy of a century. So he's telling you to buy this bank. He also just mentioned, the thing that has had the biggest move, the number one performing asset class this year is Bitcoin. Bitcoin. It's not energy stocks. It's not technology. It's Bitcoin. So he was saying, as all this went down last week, sell your Bitcoin. Well, Bitcoin is up 14% since this whole thing shook out. So it's doing what it should be doing, which is moving inversely to the banks. It's decentralized, right? That's what Bitcoin is. Cryptocurrency is decentralized. It's not in one place. It's not run by the government, allegedly. Who knows? Who knows really what's really behind it? But it's doing what it's meant to do when there's a crisis at hand. And so is gold and silver. You see these big moves in gold and silver? Like super nice move in gold last week and silver. Gold, there it is. Oh, let me shrink my screen down here. You've got gold just about hit almost the $2,000 mark. Got so close. It was like 1997 an ounce or 1993, super close. Silver's had a nice move. So that's exactly what should be happening in a financial crisis is gold and silver go up. There's a flight to quality. Now allegedly it's tech stocks, but you know, it's insane how this market just moves like this, right? These moves that are coming and they're so quick in terms of these moves. You know, like banks coming in to overtaking other banks, the FDIC reducing portfolios by 21% of value. These huge financial institutions being reduced down to such a low amount. Look at this. Credit Suisse says 17 billion of its debt now worthless. What is wrong with these companies? You know, they're so screwed up that the only logical answer would be that it's meant to be this way. Do you know what I'm saying? Like, these are allegedly, supposedly pretty intelligent people, and I've not really seen any intelligence come out of running a financial institution that holds your money. Come on. It's so beyond. And I talked about this last week. If you missed my live last week, go watch it. I talked about what led up to this. The FDIC being the fox in the hen house, or the Federal Reserve being the fox in the hen house, raising rates and also issuing bonds. You know, these banks, these big companies, they were mandated to buy these bonds, these treasury notes and bills. And then rates climbing like they are 8 times last year. There's no way you're of course when you mark to market an asset, a fixed income asset in a rising interest rate environment, you're going to lose your shirt. And that's exactly what's happened in these banks. So that's why I've always said friends don't let friends buy bonds, especially during a rising interest rate environment. The Fed was no friend to these banks, and now they swoop in and take them over. So this swooping in effect is going to create more centralization of the banking system, which basically means that our freedoms are at risk here because you're going to be, when this central bank digital currency rolls out and they're going to tie it to, you know, your health score and, you know, what a good citizen you're being. And I remember booking a flight just to Florida recently and my CO2, I had a CO2 number, CO2 emissions number for my flight from Canada to Florida. How about that? So if you care for your freedom or you like freedom, it's going to be severely curtailed. Y'all, this is happening. It's rolling through here. So how do you best get ready for it? I think you continue to buy your gold and silver coins. I think you vote with your dollars too. I think it's super critical now more than ever that you create community, that you know, stay out of for God's sake, stay out of any fast food restaurant. That's garbage food. It's not going to serve you on any level, emotionally, spiritually, healthfully at all. So, local. Know your farmer, know your meat provider, you know the person that you're buying the food from who's raising it and growing it. And it's not being tainted with anything else because there's a lot of stuff running around that's affecting people emotionally. And if your emotions aren't in check, it affects your finances too. It stops you from making good decisions, right? Fear is that thing that will actually work on your physical body, but also your mitochondria, which is the fuel in your cells. to feel good, and it affects the dopamine within your system. It affects you on many, many levels. So you want to stay out of the fear mode. And there's certainly enough to be fearful of. I mean, all day long, we're inundated with lamestream media pushing stuff through. So you just do your best to stay focused on your goals, what you're doing. Stay focused on investing your money for the highest rate of return that you can get safely. I do want to point out, I've got a stock pick for you today. Here we go. So interesting. I went to our home screen and I went to our pick stock feature, and I said, all right, show me 5-star rated stocks that are industry best only. And up popped, I left everything else blank, up popped 32 companies. And the first company here was Avista Corporation, Avista. And Avista is a 5-star rated stock. It's in the energy sector. Pays a nice dividend. You're looking at a 4.5% dividend return, but low risk. And we've got a current buy rating on it. The only reason I think it's not a stock rocket is because of the revenue growth rate. The revenue growth rate is at 18%. Let me get to that. There we go. Year over year, we're looking at an 18%. Is it showing up on my screen? Yeah, 18% quarterly year over year. So I think what's happening is companies are hitting the wall in terms of, remember just a few years ago, there would be just a handful of stock rockets. And some days even more than a handful. Like you might come to the stock rocket page and there could be 10 or 11 companies. But I'm noticing there's more companies that are not making the cut because it says due to market, there are no stocks that match these conditions currently. Our data is continually being updated, reevaluated, so please check back later. But they've got, I just did a search, I just showed you a North Star ranking of 5, and I wanted to only see industry top performers, and 32 companies came up. So here's the glitch right here. This 75% quarterly revenue growth. So we're going to go in, we're going to lower it to 50% because you remember when we first started, it was 100% and there were many companies that would pop up. So we're going to drop that down to 50 now to start showing you, because there's still some phenomenal companies out there that are worthy of your investment dollars. So we're going to make that change. We are also making a change of, because of the regulation around SMS text messaging, we are not allowed to, even though we only send out these messages to our subscribers who ask for them, we are still not allowed to do it. Any type of stock alert, because of all the scams and things of that nature out there. So we will still keep the email messaging. So if you are looking at, would that be preferences? I think that might be preferences right here. If you're wanting alerted, right, under the alert settings, to go to your SMS, we are actually stopping that. So it's only going to be email notification. So make sure that you come in here under menu preferences and click configure. Now we're going to send it to the email that we have you as a subscriber in. But if you want an alternate notification email, just let us know, and we're happy to do that. It will not be via text anymore. What we are preparing, though, is for our app that is going to launch in the next 2 months, that there will be a notification through the app. So we're going to be able to put that in the notification center. They're working on that. That was what my team said this weekend. So we're going to do our best to still get you really quick information if there's a sell rating or a buy rating on one of your stocks or whatever alert that you want to set. So, my friend, that's what I've got for you today. Have a fantastic week. A couple announcements. The Intuitive Investing podcast is live and up and going. I'll send out an email to you later today or tomorrow as to where to find that. I think we've got 2 episodes in the bag, so you'll listen. Phenomenal people. I'm getting amazing guests on this time around, so I think you'll really enjoy it. And just do your best to, be super diligent about all financial decisions right now. This is just getting started, and it will continue. We'll have more bank failures and more collapses and more buyouts and a much more centralized, controlled banking system. It's coming. There's nothing we can do about it. We're way too far down this, kicking the can down the road to make any change at this point. But during this incredible time, we've got the is it equinox? I think it's the equinox, right? Coming up. It's not solstice. I get those two confused. It is spring equinox. During this time, do everything that you can to stay on point with your goals, with whatever you want to move forward, because you've got the energy to do that. This is not the time to be distracted or thrown off kilter. Stay focused the best that you can. Do something good for your mental, spiritual, physical well-being. Go out. It's sun shining today, right? Go out, depending on where you are. Enjoy the sunshine. Get your cup filled up. Super important. And I look forward to seeing you next week. Have a great week.